Palantir is up 140% year to date. It was merely this January 24th, 2023, the stock hit a low of 584, 52-week high, 50-week low. All-time high, though, when our good friend Tom Nash, who won't reveal where he lives, in January of 2021, he picked the absolute top of the market to say, buy this company at $45 a share. The self-professed value investor sat there and said this is a value play, and we came out, go watch our videos from the past. We said we're only interested at $5 or less. It never hit that, so I don't own any shares. But again, I could be wrong. Look, the stock's currently at $15 a share. I could have missed the boat on this. So in this video, we're going to go over a lot of things here. We're going to go over some news. We're going to go in our community and see what they wrote about the bull and bear cases. We're going to go over some analyst estimates. Of course, we're going to cover our 8 pillars in the company. And then we're going to finish it off with probably the most important question you're asking, which is, what's a good price to pay for Palantir? So whether you're a beginner or advanced investor, there's something in this video for everyone. So make sure you follow along. We want to teach this process. It's confusing to start, but as you listen more and more, it'll become easier. Trust me, it was confusing for me. It was confusing for the other 200,000 people who subscribe to this channel at some point, but it gets easier over time. Let's check it out. Mo, this is a $32 billion market cap business. If you want to buy every share outstanding, $32 billion. Yep. But the enterprise value is less than that, 30.24. What does that mean? This market cap is buying every share in the market. This is buying every share and adding in the debt and subtracting the cash. So you actually get cash at closing, essentially. You're going to pay less than the market cap to own the company. That's a solid, solid balance sheet. Just to compare it, let's look at a company like Nike. Nike is a big company, down a lot today. Their market cap's $155 billion, and their enterprise value is $168. Most companies have a higher enterprise value than market cap because they don't have enough cash to pay off their debt. Palantir does. They can write a check and pay off all their debt in the company with a stroke of a pen. That's a great business, okay? Another thing I love about Palantir, 79% gross margin.
It's very large.
That means every extra thing they sell, 80 cents of it goes to the bottom line. That's incredible. Now, some interesting things about Palantir. Their net income last year was a loss of $48 million. And over the last 5 years, it's averaged a loss of $460. But one of the benefits, their free cash flow last year was $375 million. And in the last 5 years, it's averaged negative $6 million. So they're showing cash flow much better than net income. Much better than net income. Mo, isn't that awesome?
Yeah, I'd rather see that.
That's something we've always talked about with Palantir. But there's also been some weird stuff. Remember the past? What was the weird stuff that occurred on Palantir, Mo? Do you remember?
They would beat by like 1 cent per share conveniently every single time.
And they would have some new accounting thing they did that just barely beat.
Yep.
That was kind of a red flag for us.
Always make them beat by 1 cent.
Always. By the way, but this is the thing, is like 9 or 10 quarters in a row of free cash flow.
Yeah.
And that's a big positive here for the company.
It's, as far as I can see, 5, 6, 7, 8, 9, 10.
10 quarters?
Yep.
Let's look at their quarterly revenue numbers. So look, for example, here. They did $533 million in the last quarter. And the previous year's same quarter was $473. That's a growth of 15% year over year. Okay, that's pretty good. That's really good. But I would have expected more for a company like this.
Right.
Now, I do know they've been trying to get a lot more contracts. So they have to get a lot smaller contracts to get more contracts.
Right.
But their job is they're going to take data and answer your questions, solve your problems, whether you're a government or you're a major corporation. And also one of the founders here is Peter Thiel, who we love a lot. He's one of the guys who funded Facebook to start. He did PayPal. He did a lot of great stuff. So very smart man. So Mo, why don't you give us some of the bull and bear cases in our community? Because we have our chat here and we created the chat for Palantir. Why don't you go through some of the things that people loved and didn't love about the company?
So Ciatra said it's a monopoly on what they're doing. Actually, it's like one of 3 companies out there that are doing this. So it's not total monopoly, but there is no other company that takes structured and unstructured data currently that he knows of. It is one of 3. Their new AIP product is very clever. They will integrate large language models into privately operated networks. It's one of the true AI companies that does AI well. They helped catch bin Laden back in 2011.
Did they really?
When nobody was caring for AI. Interesting. Now his
we got to verify that.
Yeah, what he calls crap case. I like this.
Crap cases, not fair cases.
They have shares outstanding. I'm assuming increasing 190%.
Stop right there. I want you to see, guys. I want everybody to see this. This is very, very important. This is that we call this the silent killer in investing. What this is it's sitting there saying, look at the number of shares outstanding. You go to our income statement, go to the very bottom, 713 million shares 5 years ago, 2 billion now. This is diluting investors. Let me explain how. Let's say a company has 10 shares outstanding and you own one. You own 10% of the business. If they all of a sudden go from 10 shares to 25 shares, like that happened here, you still own one share, but now you're an owner of one share out of 25. You now own 4% of the business. They just diluted you by 60%. And that's what essentially happened here. So even though the business might have gotten 5 times better, you only saw like 2 times growth in that one. It's the silent killer investing, and I hate the fact they do that. But now that they're cash flow positive, it might be slowing down. You'd think so, right, Mo?
Yeah. So this is interesting. He elaborated a little more. So they diluted a lot of shares in 2021, got rid of their debt. So they kind of switched. I'm not sure if that's I can't say that's true or false.
So they issue share, paid off debt.
Shares paid off debt.
So let's talk about that. Let's say that is true. And we haven't done the research to verify or not verify that. If somebody out there can verify that, put it in the comments below on YouTube. Yep. And somebody in our community, please verify it and put it in our general chat, tag Mo and I. I don't like that because why would you pay off lower interest debt if you think the company has a ton of potential? If you think the company can grow at 15, 20% a year on earnings per share, you would want to keep your debt as long as it's lower than that. So I don't really get that very much, but it could be the company's way of saying, listen, we don't like having this debt outstanding. Let's remove that. I think Mo just tagged everybody in the, great job.
This is more from him. It's not a value play. It's a speculation growth play. So way more risk. Having their earnings always beat by a few cents seems catchy, actually a big reason to avoid. So it looks like he's avoiding. I don't
agree that it's necessarily not a value play. Value is found in paying less today than what you think a company is worth. Yep. And with a company with a lot of growth potential and free cash flow, I think it's easier to figure it out. Now, I do believe it's more speculative because I do worry about the potential of this, the growth rate. The growth has slowed. And also the fact that the dilution is still an issue for me. And the beating by a few pennies. It shows me that maybe and by the way, I think a couple times when they beat, there were options that were going to be exercised that came into play for those executive teams. So are they in it for the investor or are they in it for themselves? That's the question. Yeah. A couple other people. J Money put bull case, gap profitable, no debt, growth rates are still scaling, margins are solid, difficult switching costs. Okay, so he means basically if you're an existing customer, it's hard to switch to somebody else. Client base have deep pockets and or pre-approved budgets. Okay. Possible S&P 500 inclusion will help volume long-term. Okay, great. Fair case. Too many bleeping shares. CARP is a wild card. Yeah. Certain markets growing extremely slowly and or not at all. Not scaling as quickly outside of existing client base. Okay. So there's some issues there.
So one other bear case that I actually got from our analyst, Dalton, he said that those government contracts are year to year. So it's not that they're guaranteed after 1 year.
They're year to year.
Mm-hmm. I did not know that.
Okay. And Keenan asked the question, apart from just saying they analyze that, what do they actually do? Yeah. Like, does anybody know anybody who's used their product? Listen, they're very, very big, like contracts are like $5, $10, $20 million. None of our neighbors are doing that. Right. And I imagine there's probably a lot of confidentiality on it. Who knows? All right, so let's go back to the software portion of our community. And let's take a look at analyst estimates. Let's look at the 8 pillars first. And remember, guys, if you're part of our community, you can customize your pillars up to 12 different pillars and 4 quadrillion different variations. All right. But on the pillars, a lot of X's. Yeah. PE, negative. 5-year price of free cash flow, not really existent because they're negative as well. Shares outstanding up 190. Listen, you're not buying this on our pillars. No. To me, this is just saying the pillars are telling a story here. And by the way, you should never buy or sell based on pillars. But these are the questions to all ask. Why are these like this? This is the thing to me. It's got to stop first. I got to feel comfortable they're not going to issue any more shares and dilute the crap out of me. All right. Let's look what analysts are saying here.
I'm actually quite surprised at the earnings per share. I think I said this in the last video too.
What's that?
That I can't believe how little earnings per share growth there is over the next 5 years.
Holy cow.
Yeah.
You're right. They're expected to make 22 cents this year and grow to 48 cents in the next 4 years. That's only 125% growth.
Yeah.
Wow. Yeah, I would have thought much higher.
Mm-hmm.
All right, revenue growth. That's the thing. Look at the revenue growth. Revenue is almost like revenue growth is 2.5 times, which is it's 138% growth. Because it's not. People always confuse that. When you double, you go up 100%. So if you up 2.4, it's 100% plus the 0.4, 140%. So that I agree with you, Mo. It is not as much growth as I would expect it on the earnings per share.
Yeah.
Now the free cash flow may be a different story.
True.
And at the end of the day, free cash flow is what matters. And I like the fact that this company is showing more free cash flow than earnings by a mile. I love that completely. So it leads us to our final question. What's the appropriate price to pay for the company? So before we get in the stock analyzer tool, as you guys know, part of our community is a community of traders. And Mo here is our expert trader. Mo, why don't you take a look at the charts and see whether you see anything from the charts. Now remember, when it comes to the charts, we don't care anything at all about the underlying fundamentals of the business. Mm-hmm. All that matters is what do the charts show.
So to me, this is one of those companies where if you were very, very patient, you are going to do very well. And the reason I say that is if we just look, this is a long-term chart, and you can just see over the past year, you can see that it's just kind of stuck in this consolidation range with the exception of this little area up here. So if we can get this thing to just break, if you can be patient and let this break out above or below that consolidation channel, that's exactly where you're going to be able to make your money. Just be patient. Don't get caught up in all of the hype, the day-to-day and the movement. You can do that if you're day trading, absolutely. But this is a great opportunity to just sit and wait. And this probably sounds like Chinese to a lot of people, but we have a web class that's going to be coming up
12th of September at 2 p.m. Eastern time.
Yep.
Sign up at the link below. It's an absolute free web class where we're going to talk about trading and how you can add it to your tools. You know, one of the things I like about trading, Mo, is it allows me to, like, when I'm waiting for my fundamentals to get better on a company, exactly, it allows me to keep busy so I don't force myself to always keep making decisions.
And this is one of those companies where I don't necessarily want to own right now, but I would absolutely trade it if I get an opportunity to do it. Absolutely. And it can be one that can move a lot because there are so many people that hype it up and down.
Absolutely. Okay. So now the stock analyzer tool. And remember, guys, this is our most important, most used tool, our most popular tool in our community. The reason being it allows people to make assumptions about the future, not considering balance sheet, but make assumptions about the future of the business. And it'll tell you, based on your assumptions, what price to pay for the company today. So when was the last time we did Palantir? Let's pull that up and see if we still agree with the assumptions. Palantir was done August 21st at 11:12 a.m. Eastern time. Let's pull it up and see if we still agree with this. All right. We did a 10-year analysis. And again, you can do up to 20 years here, but we did 10 years. Mo, revenue growth, we did 12, 18, 24. What do you think?
I like it.
I will say this, though.
Okay, go ahead.
The 15% growth from last year kind of concerned me.
Yeah.
Because they really made an aggressive attempt to get more and more clients at smaller revenue numbers.
Yeah. So you think we should just go lower on the low end?
Maybe
8,
maybe 9, 15, and 21 might be better, or 8.
I kind of like the 18 and 24 just because I think that's probably where they'll land.
Okay.
But I do see your point.
Can we just do
lower.
8, 16, and 24?
Sure.
Okay. So what we did sit here is we look at this, and this happens a lot, guys. We see information, we sit there and change. The point is, you shouldn't be buying a company that's barely, maybe. Right. It's one of those things where, yes, we always come up with different numbers every time we run the analysis, but it's rarely going from a point of like, this is, because the point of being an investor is you want to buy when it's pretty clear that you should own this company, not when it's, maybe. So profit margin, this is the hardest one for me because they haven't shown a profit. So we're speculating
10,
here.
20, 30. I think it's fine. It's a fair speculation.
Fine by me.
Yeah.
Profit, free cash flow?
Higher.
Oh, you want higher?
And current.
Oh, I'm sorry. You're meaning it is higher, but higher. I agree with 15, 25, and 35.
Yes.
I'm still fine with that. I'm still okay with that. Now, the next two questions. What earnings multiple and what free cash flow multiple should we assign to the company at the end of the 10 years of this analysis? What should it be selling for in the market? The market average is 15, but you want to go higher or lower based on return on invested capital, its growth rate, its moat, etc. So here, they're one of 3 companies doing this, probably the market leader. I don't know who the other companies are.
Yeah.
What do you think, Mo?
15, 20, 25.
That's what we did last time.
Yeah.
I'm only putting that in there because I really have no idea what else to put.
Exactly. I mean, I don't know if it's a high of 40. I don't know if it's a low of 10. I just don't know.
No clue. And that's what's hard about companies that are still in their early phases and still growing like
and almost
crazy.
An industry that it's in a new phase.
Yeah.
I mean,
yeah, it's a new phase industry.
3 companies.
Yeah, AI. I mean, people are like talking about AI too. Like, oh, they're going to implement, but they've been using AI in some fashion for a while.
Yeah.
Now, finally, guys, what is your desired annual return? You can get 9 or 10% from investing in a long-term ETF. So obviously, the riskier the proposition, the higher assumptions you make, the more return you need. I think there's a lot of unknowns in this company, a lot of unknowns. So we actually had 15, 20, and 25% as our desired annual return. Because we really sit there and say, listen, if it's going to, at this point, the juice is worth the squeeze potentially. But if you're trying to make 10% on this, I don't think that's a 10% company. I think you've got to get a higher return because of how many unknowns there are and the risk involved. Mo, what do you think?
I did 15, 20, and 25%.
As well as I did. Okay.
Yeah.
So, guys, we hit the analyze button. Do me one favor. Stick around for just 1 or 2 more minutes. Let's see the end of the video. We're going to explain the numbers a little more detailed because remember, we're trying to teach you how to use our community and our software to make better decisions for yourself. And it's just our process we're trying to teach. So, value. $1.30 to $2, $8.50 to $10, and $4 to $5 for the middle number. If you pay today's price and the low assumptions occur, you're going to lose 10% a year. Today's price and the middle assumptions occur, you make 5%. High assumptions occur, 19%. So there's a lot of potential here. And we put in, I have it on my watch list at $6. I'm fine with that. At $6, if it goes there, I'm going to take a deeper look. I will say I don't like the fact that the numbers seem to hit on the earnings just at the right time perfectly. That would actually get me to possibly never own the company because I don't think it puts us in the same light, in the same line with the main management team. So guys, thanks again for watching. Again, we have our community. We have our live stream next week, webinar on trading. Click the link below, sign up for free. Thank you for your time.